Hello and welcome to Forex.Academy, the #1 website for Forex and crypto education and analysis. In today's edition, we're going to be looking into buying and selling the Forex market, the path to financial freedom. There is an old adage in the financial markets, buy at the top and sell at the bottom. This might be better applied to the second-hand car or housing markets than financial markets. In truth, it is meaningless in the Forex market, but it does have some strong connotations. Within the Forex market, a currency pair, in theory, has no top or bottom. Rather, one currency can be valued against another currency as having an intrinsic value that fluctuates either below, above, or at parity with the countercurrency within the pair being traded. Therefore, within the Forex market, we have a multitude of various levels which can be broken down into floors and ceilings, which are also known as areas of support and resistance. And so, as traders, we look to buy and sell currency pairs from areas of support and areas of resistance, or to sell them from areas of resistance to areas of support. We then look for continuations or signs that we should exit our trades. The absolute best way to ascertain where these areas or floors and ceilings are is by way of technical analysis. Traders then use trend lines and other technical analysis tools on their charts in order to highlight where the price action of a pair will bottom or top out and reverse. Traders then use trend lines and other technical analysis tools on their charts in order to highlight where the price action of a pair will bottom or top out and reverse. Of course, traders would love to execute a trade and have it roll on in their favor for a couple of hundred pips every trade. In reality, it hardly ever happens like this. Even the most reliable technical analysis setups will not work 100% of the time. What really matters most is that a trader's methodology or style means that they consistently win more trades than they lose, and that each winning trade is greater than each losing trade. And therefore, traders must incorporate tight stop losses while utilizing their tried and tested trading criteria. Now let's break down a buy trade to its bare bones, but before we do, let's just go back to our adage for one moment. Buy at the top, sell at the bottom. As traders in the Forex market, we have to establish where the multitude of tops and bottoms are in order to give us an advantage in our trading. When you break trading down into its base elements, traders simply like to push an asset as far as it will go. In other words, in Forex, they buy a currency pair until it runs out of steam and stalls at a ceiling, and then after a period of consolidation, they will either continue buying it or they will reverse the process and start selling it as far as they can. This is a 4-hour chart of the Euro-USD pair. Always read a chart from left to right because it tells a story. Here we can see that price action was unable to rise above a ceiling or resistance level at position 1. Traders then pushed the pair down by selling it to the area of support at position 2. Price action then goes up to the previous ceiling at this time and punches through at position 3. Price action moves a little bit higher before falling back at position 4, and where our previous ceiling has now become an area of support, traders now start buying the pair all the way up to another area of resistance labeled 5. When they could not push it any higher, price action moves down to the previous area of support at position 6, and this time punches through. We then find a continuation trend to the downside. Let's take a look at example B, which is the same as our previous chart for the Euro-USD pair, but we are going to have incorporated some potential buy and sell levels. Again, using our levels of support and resistance, we are looking for opportunities when the market pulls away from these levels. At position A, we find the market is moving below the area of resistance, which presents as a selling opportunity, where a stop loss marked X is placed just a few pips above the resistance line. When price stalls to the downside, we are presented with a buy opportunity at position B, and where our stop loss should be placed a few pips underneath the lowest candlestick at the support area. At position C, price action falls back to the support area, we get a second buy opportunity as marked by the arrow, and where traders would typically place a stop loss just under the previous resistance level, and which now has become a support level. Now it could be that traders are still long having bought the pair at position B, but later in the chart, when buyers lose momentum, we see price action fall below the support line and we have a sell opportunity at position D, and where our stop loss should have been placed a few pips above this level of resistance. So, when it comes to buying and selling a currency pair, we look for defined areas of support and resistance, and more importantly, areas where traders push through these levels, which is typically when we might see a continuation in price action in either direction. If you enjoyed the video, please like and subscribe, and comment down below if there's anything you'd like us to cover in future, or if you would like to discuss the topics we have covered. Have a great day.